Hi, everyone. This is Rohit from Rise from Mastery, and I'm excited to have Arian Ghashgai, who's a partner at DVC and a general partner in Earthling VC, and is also a machine learning infra engineer within Meta-related labs. Thanks to Dave Goldblatt from White Capital for the introduction. Welcome to the show, Arian.
Yeah, I'm really excited to be here. It's going to be fun.
We talked about that you born in Germany, and then you moved to the US. How was your childhood, and what got you really interested in getting into this world of startups?
I think I always had a bit of, I guess, an entrepreneurial drive, if you will. Like, I think even as a kid, like one of my favorite things to do is just to build Legos and, to go free form, right? Not to follow the instructions, but just I want to you take these blocks and make my own building, right? And even as I grew up, like as a teenager, I did it with like music production and these sorts of things. I just like want to, I like it. I just want to learn how to do it myself and build it. And like I made pocket money in high school, selling hip hop beats that I made to artists and stuff and that sort of thing. So I always had this sort of, I think, drive to just build things. I always thought it was fun. I always had that sort of, I guess, creativity. And as I think really started with that when I was in college, when I took my first step at like a real sort of business, and so dropped out for 2 years. I actually do that full time in between my studies and all of that. And I think I realized from that like I love startups, I love the thrill, I love doing it. There's I think so much you can really create doing that. But also I'm a crap operator in the end of the day, and decided that maybe my talent is better served on the other side of the table as an investor. So I've really been doing that kind of for the last few years, and it's honestly extremely missionary for me. I think a lot of people look at it as a kind of a financial instrument or something like that, but I see early stage investing and me being really just focused on pre-seed, really as kind of missionary, because I think you're in a position to catalyze kind of the future, and that actually has a lot of responsibility. I think that comes with it, and so for me, I feel like it's actually a very a meaningful contribution that I can make to the future of society, if you will. And again, that's also specifically why I'm focused on pre-seed and not, kind of growth stage or something like that, where I think it's just a different kind of game that you're playing. But kind of being really, really early with the missionaries, so to speak, is a lot of fun for me. So it's kind of been the best use of my time, I would say. My time on this earth is spending time with founders and helping catalyze some of the successes and so on.
Yeah, no, absolutely. I think I really love being in the space of pre-seed and seed, and that's where spend most of my career in. But you also spend time building a Rapify. What was the platform all about? When you built the company?
Yeah, I mean, so that was kind of the first real entrepreneurial endeavor, I would say. So that was kind of the background for that. So I went to German International School when we came to the US, and I also graduated high school from there. And so one of my good friends at the time was basically like a musician, like an artist, and he'd make music, German market music and all that sort of stuff. And so after he graduated, he went back to Europe and actually started to get somewhat successful, right? Like he would became very well connected and went on tour and these sorts of things. So he kind of picked up as an artist. And at the time we were making music together in high school, like I'd produce for him and all that. Like I mentioned earlier that, I used to like sell beats and stuff. So I used to produce a lot of his music, and we'd always talked about the industry for a while, that there's like no discoverability, right? There's not really any means for kind of indie artists and stuff to distribute their stuff. So this was like 2013, 2014, we came up with this. And I think the idea was kind of like effectively like of a pseudo SoundCloud, Spotify kind of streaming service that was very geared towards the German market. And I think some of the very idiosyncrasies within that market that we wanted to address. And we thought, well, I can build it, right, as being an engineer by background, and he now has kind of the network there to really start spreading that amongst artists and kind of solving a bit for that cold start. So we just decided to do it. So I was in college when we started it. Decided to drop out at some point to focus on it full time. But yeah, that was really like I think the inspiration is we'd known each other well, we'd worked together, we talked about it for a while, and I think we kind of finally saw that like we have some circumstances in our favor here, and let's just go for it. How it went, of course, is a different story, right? And I think I could write a whole postmortem on why that company failed. independent of maybe like other like kind of broader market trends and stuff. But I think just like where we screwed up as entrepreneurs, which is of course also then like insights you take into your investing, right? But yeah, that was at least the origin.
Interesting. You say you dropped out of the college. Were your parents okay with it? Coming from an Iranian immigrated, somebody who's like an immigrant. Did you
Yeah,
able to convince your parents about it?
I think so. I mean, I would say my parents definitely were used to the idea of risk, right? I mean, they also kind of they're also like self-employed, right? And, like I think my childhood was very up and down because of that. It's like they weren't the typical like, oh, we're immigrants, we're going to be like super successful entrepreneurs and all that kind of, it was definitely a grind. It still is to this day for them. And so I think to some extent that it also took the fear out of it, right? Like I think my parents were definitely supportive of doing it because that's a sympathy to it. I wasn't that concerned because, for lack of a better term, I'm used to kind of turbulent existence up to that point in time. So it was like, wasn't really a big concern for me. I will say though that, and this was the hard part at the time, not necessarily my parents, but kind of everyone around you was like telling you you're crazy, basically, right? Like, there are very, very few people I would say that, were like kind of encouraging, and they're like, the most the rhetoric was like, are you sure you don't want to go back? Or maybe you should finish, things of that nature, right? And so I always say that's probably the best decision I made in my life was actually dropping out and doing it, even though the company wasn't successful, going back and all this stuff. Because I think it just really set the groundwork for everything that came after that, right? And like for example, I started working at Facebook right out of college, and I don't think that would have been possible for the school that I went to without that experience. And even all the interviews and stuff were all about like asking me about that startup and these sorts of things. And it's just the stuff that I learned, which subsequently let me like focus on different things when I went back to university and these sorts of things. By far, I think the decision that I'm still reaping benefits from today. But it was, yeah, I mean, I think it's might have been difficult to pull through with that if I wasn't completely convicted that like I'm doing this from the motivation that I think like I will just learn the most doing this. Like I will learn more. I really take more meaningful experience away from doing this versus just kind of doing the usual, like going on my normal university path. So it's something I actually, to be honest, I have these kind of conversations with when I talk to college kids a lot, or even high schoolers, where there are the few of them that like, yeah, I have this idea, I'm thinking about doing it, whatever. I always tell them just do it, right? Like if it's something that you think that you're gonna pull something out of it, even if it doesn't end up being successful, but just you see that there's a lot you can learn from doing it, just do it. Because particularly at that age, you have nothing to lose, right? Like you don't have bills to pay, you don't have a family, you don't have debt, you have nothing, right? So it's like it's the optimal time to just go out and try something. Whereas like now, even me currently, like if I wanted to do something like this, there are a lot more things I have to think about, right? I have rent, I have a car payment, I have all these sorts of responsibilities, right, that I didn't have when I was 20. And so especially looking back, I'm like, yeah, that really was the best damn time to try to just say YOLO, like I'm going to try something, and just do it basically and see what happens. So best decision ever. Not easy, but best decision ever.
Awesome. Yeah. Very interesting. And and you talked about that you invest into pre-seed and seed, and you come in very early. What are some of your rules when you look at angel investing, considering that you started doing a couple of years back?
Yeah, I mean, I think a sort of sector aside, right? Because I'm obviously very sector focused on VR and AI specifically, or I should say more kind of 3D and AI specifically. So like that aside, right? If I'm just evaluating within that thesis, I always say like 90% of it is about the team at that stage, particularly pre-seed, right? Because it's like there's not going to be much. I mean, there are going to be pivots, right? That's all stuff you have to account for. The idea might not be the same in a year versus what you invest in today, right? So I think the thing that you need to be particularly convicted by is firstly just the team. And so I'll dig into that, but then also just generally liking the market. And I think the sort of vision that they're going after, right? Because I've had a few companies, for example, that they're doing very well, where their strategy changed, right? The product changed, but I think the end vision that they wanted to work towards, like the future that they wanted to work towards, is pretty consistent. It's just the means of getting there changed. But I think you really want to invest in like good people, kind of really thinking into the vision of the future that you imagine. I think on the founder side, there are definitely a few signals that that you can look at. I mean, I think first and foremost, you just gotta, like, as an investor, it's like a very personal thing, right? It's like, you just have to decide, like, hey, is this a kind of guy or the team that I like enough that I want to talk to them once a week for the next few years and basically be married to them for the next 10-15 years as their company is successful. That's a very personal thing, right? So I don't think there's any specific like checkbox there. That's just effectively vibe check, right? It was like, I think the very first and foremost thing. Like, I have very good relationships with a lot of my founders. A lot of it's just rooted in that. It's like people I just get excited about and they get excited about me, and it's just a fit, right? That's two-sided, by the way. It's, I think also, if you're a founder and you're looking for pre-seed angels in particular, like, don't take people just because of the money. Like, if you don't like them, if you don't get along with them as people, I think also for founders, it's very important advice. I think on a more technical level, of course, you're looking at some sort of credential from the standpoint of, like, do you have reason to believe that they can carry out the vision that they want to carry out, right? So, if someone's pitching me an AI company, I obviously want to see some pretty legit like ML experience there. Just as like, to give you some data points that they can actually do it, right? They know what they're talking about. And then the single most important thing, I think, beyond that for me is iteration speed. So like, how much have you done with what you have in a certain period of time? And the founders that I tend to get very excited about, I think, are the ones that really have managed to really build a lot of product or generate a lot of traction with very, very little resource in a very short period of time. That usually is a pretty good indicator to me that they're going to be hustlers, first of all, because that's really what you need at that stage. But also that they're extremely competent in rolling out product, and they'll be able to pivot quickly, right? They'll be able to move quickly, which is, I think, very important at pre-seed. And I think particularly when you're playing in spaces like, let's say, AI now, right, where there's really going to be a lot of competition, and I think the landscape will change very, very quickly. You really want to see that, okay, you're backing a team that can be very dynamic and can react and iterate very quickly. But I think those are the main things that I really look for at pre-seed.
Interesting. And you've invested in a couple of startups. What are some of the biggest mistakes you've made when angel investing?
Not listening to my guts. There are a few investments that I've done, not a few, that maybe one or two, where I think I tried to take an over-rational approach to it, right? Where it was like, objectively, a lot of things here check out, right? Like, objectively, the team is interesting. Objectively, the market they're going about is good. Objectively, their penetration to the market has been good. And so basically, we check all these kind of like conventional boxes, right? Of like, this seems like to be like a good bet, like interesting co-investor signal, so on. But for some reason, I was just never really like, really like in my gut convicted that I want to do it. And I did it anyway. Like, I think some of those I look back and think to myself, maybe those I shouldn't have done, for a number of reasons. Not even that the investment does poorly, but I'm just like, it's not one where I can like, I want to really be able to vouch for my portfolio, right? Like, I want to be able to like go and like with all of my conviction tell somebody how great one of my companies is, and I just can't like honestly get there with like one or two of them. And again, there's no like hate on them. It's just, it's like, it kind of goes back to that vibe check thing I mentioned earlier. Like, maybe we were the best, founder investor fits. So those for sure. I think there are also some where it was maybe the other side, where I wanted to overlook particularly the iteration speed part, which is why I'm very sensitive to this, where, oh, I like them, I like the vision, all this stuff, and I do it, but I was like, maybe if that investment did poorly, and when I was diligencing it, if I would have spent more time looking at what have they done so far and really analyze that, I might have passed, which would have in hindsight been a good financial decision, because some of those companies have done poorly. Those so the two opposite ends of the spectrum, but I think the vibe check one is the biggest one. And there are definitely a few folks, kind of pre-seed VCs that have been around for a long time, very successful, that I think I've heard similar sort of sentiments from, that for them a lot of it just ends up being about vibe check, right? That like, even if it all sounds great, but their guts just not there, they pass, right? And that's
Right.
something that's been extremely successful for them. So I think I'm kind of learning that too now.
Got it. Interesting. And I wanted to understand about, what is the thesis for Earthling? You focused on 3D, but AR, VR, and AI. What is the difference in all three of them? And why are you so focused on?
Yeah, I think that so the philosophy of the fund is basically enriching the human experience is like the core tenet of the fund, right? Because I think also when you think of a fund, actually the term I should use is firm, right? Because if I'm starting this, I'm thinking this is going to exist for 30 years. I
Right.
think there's a core philosophy behind what you want. And so for me, it's enriching human experience effectively with technology. And so if I look at kind of what's been happening in computing for the last, let's say, decade, um, long story short, through my own experiences, I've become pretty convinced that like both AI and 3D spatial computing, AR, VR, whatever you want to call it, are going to be the two computing mediums that like fundamentally, I think, change just they augment our capability, first of all, subsequently is going to have this downstream effect of really, I think, disrupting a lot of things in society, both how we do things, how we interact with each other, so on and so forth. And that's a big deal. I think those are, which is, by the way, also why I've spent the better part of the last decade working in these fields, both in kind of as a machine learning engineer, but also in the 3D space. I think there's a lot of tremendous upside that can be generated through that, but there is also a lot of downside risk. And so one of the reasons I got into it just on the operational side is that like I want to understand this stuff so I can understand these risks and play a part in that. And I think now as an investor, I think I have both kind of the business side, but also the technical side to really pick at a very early stage which companies are obviously have a chance of being successful, but also which ones are doing something good, right, for us. In other words, like which ones are driving like good second and third order outcomes, which to me is very important. So because I see those two technologies as being at the forefront of that, at least from my kind of point of view in software, I wanted to focus on that. And again, also that's where my background's from, so it lends itself. Now, I mentioned that thesis of a kind of 30-year philosophy earlier to say that like this is the focus now, but I could see that evolving over, let's say, the next couple of decades, right? Like who knows if these are kind of like really the preeminent augmenting technology, so to speak, in the next in 15 years from now. Like who knows? Right now it is. Who knows what's in 15 years? So that part of the thesis could obviously change, but right now, like I think in computing, those two things are really at the forefront, and particularly I think when they start converging, I think is really gonna drive meaningful change, and we want to make sure we're doing the right thing there and not drive us into dystopia effectively.
Got it. Interesting. And especially, with what happened with, OpenAI with ChatGPT, I think it's been on the news for past month or so. But do you
Yeah.
think AI will replace a lot of the SaaS companies, or do you think it's going to? I mean, a lot of SaaS companies are going to be there, but AI will just displace people who are doers, who are not thinkers.
Yeah, I definitely think so. I mean, I will preface this by saying that I do think some of the you see two streams of thought right now, which is like the hype train and the doomerism. I think the answer is probably somewhere in the middle in terms of where the actual capability is. Like, to be perfectly honest, like I always say, I was actually more blown away by GPT-3 when it came out 3 years ago. And I remember that moment exactly. I remember I was sitting in a cafe in like May 2020 reading the paper, and I was like, holy shit, right? And so I don't think anything OpenAI has done since then is actually as an ML engineer, like kind of sort of kicked me back on my chair more than GPT-3 at the time. So that's something I always use for context. But yeah, I definitely think that you see where this is going, right? And a lot of it is co-piloting, right? So in other words, like one of the great use cases, of course, is writing code, or like, kind of helping with as a writing tool, right? But it doesn't do the whole thing, right? What it basically does is I think it lets you iterate through concepts significantly faster, right? And that's true for writing, that's true for image generation, so on and so forth. So I think a lot of these jobs that I don't know if they're going to go away, but they might be reframed, right? Like let's just take a software engineer. I think what ChatGPT does, or let's just say GitHub Copilot does, is effectively a lot of what like a junior engineer, like an entry level coming out of college kind of engineer would do for like a tech lead, right? In terms of like the tech lead will tell the junior engineer, write a function, right, and do this. And so I don't think that that tech lead is at any imminent risk, right? Because they still have to build the system architecture. There's a lot of actually creative kind of alignment work and stuff that needs to happen at that level that ChatGPT cannot do, but it might do some of the work that the junior engineer does. And so subsequently, like, does that reimagine what an entry-level engineer might look like? For example, I think that's, for example, a big question. I think you'd say the same about writing. Like one domain I look a lot is obviously gaming, because that's very kind of within the 3D space. And I think there's the same kind of question around gaming. Game designers now, they like, what is that going to look like, right? Where my thesis is that, like, I don't think less people are going to have jobs. I just think that more of the designers, or their output's going to be 10x, which you actually need. For example, if you want to build a kind of fully immersive VR world, like, you just can't do it manually quickly enough. So that's actually good. So I think really what it does is it raises the bar for what we can actually accomplish with small teams. So it just kind of 10x is the potential output we'll have in certain domains. And I do emphasize that last point that, I think a lot of this conversation about how, like, ChatGPT or whatever is going to just take over everything. Like, no, I think, like, there are very clear domains where this will be relevant and it will 10x the output. But it's kind of might be limited to that, especially initially. So I see it as net positive, right? And the issue is, I think, there's a lot of the framing around it, and I think you might have hinted at that a little bit, which is, I think it comes across psychologically very differently to people if you frame it as a technology that augments your capability. In other words, makes you more productive. It lets you do more. It actually supercharges your own capability and creativity, versus saying, like AI colleagues, which has this sort of like humanization factor of the technology, which can get scary, right? Because it's like, you can start dooming on that sort of framing a lot, right? Because it like indicates that, like, maybe we replace people, maybe all of a sudden we have this other kind of artificial instance that's our equal. And that, starts to, I think, provoke like kind of dystopian thoughts. And so I think the framing is a lot of what freaks people out about this, rather than the actual output, right? So I think if you objectively look at the output, you steer it in the right direction, because what I was saying earlier, a lot of really good stuff can come out of this. I mean, like, I think it's great if you tell someone, like, all of a sudden you tell an artist, for example, that, hey, you can iterate through your artistic concepts 10 times faster now, because you can basically get a machine to do some of the concepts for you. That's great, right? It's a new skill set, right? But, like, I think that's actually a positive output for everybody. But I think the framing is what's kind of freaking a lot of people out.
Kind of interesting. And I wanted to talk about how investors can add value, in a sense, like, what is the best way a founder can build a great relationship with the VCs? Then what, in your view, has been the optimal way to build those relationships?
Yeah. I mean, I always say like what I mentioned before. I think kind of off the notion of this vibe check thing that I mentioned at the beginning. In the end of the day, like, investing is a very personal thing. I mean, like, I don't really track much, to be honest, beyond Series A, but, like, I think A downwards is very, very, it's very people business, right? And so people like to invest in people that they know and trust and like, effectively. And so that goes to say that if you're a founder and you're looking for founding and you're very early, I think one of the best things you can do as a CEO is take, let's say, 10% of your schedule and allocate that to just talking to investors, taking inbounds, like seeing who's out there, and treat it very casually. Like, I've seen a lot of investment decisions get made on people where, they had a pre-existing relationship for over a year, right? And it was just very casual. And I think, again, like, a lot of early investors tend to also be kind of geeks, right, in particular fields, right? So they tend to actually just like the fields they invest in. So for them, like, to have a founder that's telling them something interesting or that they like or whatever is like it's just something that they do without most of them, of course, not all of them, right? But a lot of people would do without any sort of like transactional component to it. And so I think it's important also as a founder to just treat things that way, right? That, like, investment is not just a purely transactional function. Like the investment itself might be, but the work leading up to it isn't, right? And like it is people at the end of the day, right? So building relationships just with investors that you like, and getting them to trust you, getting them to see a body of your work, right, over time is, I think, the best way to convince somebody to write a check. And I think also it'll reduce the actual time that you go out trying to raise, if that makes sense. Because by the time you decide to raise again, you would have already had all these relationships built up with people that you, by the way, also again, it's always a two-way street, right? That you yourself as a founder have determined, like, hey, this is an investor I actually want involved with my company, and they like me, and we have a relationship with them. They've seen us operate for 5, 6, 7, whatever it is, months. Those sorts of deals can get done a lot faster, and so it'll just give you less headache trying to raise. And ultimately, I think it becomes less of a distraction, right? Because I think one of the worst things that can happen to companies is, the CEO gets completely sidetracked and trying to fundraise for 6 months, and actually kind of lose sight of the operating. I think if you kind of do it in this way, you can meet that balance a lot better. So I would say always look at it as like investors are people, right? You got to get along with them. They function like everybody else, right? It's just kind of treated that way, like treat it as like you're building a relationship, right? And it doesn't have to be, don't treat it as being like exclusively transactional.
Got it. Interesting. And you made an interesting point that you can have build a relationship and have that casual relationship, but in 2023, it looks like there's impending recession, and it said that it takes you 3 months, 3 to 6 months to raise a round. But suggestion would you give to founders who are looking to raise the next round of funding? And what do you think 3 months to 6 months is the ideal time for them to raise the next round of funding? If they have raised a pre-seed and they're looking to raise a seed round.
So you're saying in terms of the time it would actually take them to raise, or you're saying I mean, it's very case by case, right? I think a lot of it's how you get set up, right? Like, again, it's kind of like what I mentioned in the last part, like, I think a lot of founders that have kind of built VC networks over time will just naturally raise quicker because, they have to do less cold outreach, right? They have to sort of like, they have to pull less strings to try to get in front of certain VCs and then build relationships with those VCs. And that all kind of takes time, whereas there are a lot of founders that have those relationships very, very fast, right? And a lot of those conversations go quickly. So it's very case by case. There are other things that happen too, right? I mean, like, let's say you're raising and a big name investor or big name fund, signal fund, decides to come in. Like, let's just say hypothetically you're raising a 5 million round, and hypothetically Sequoia and Andreessen Horowitz comes into your round and takes half of it. For you to get the follow on for the rest of the 2.5 million that you're raising is going to be very easy. Right, like versus not having it, right? So there are a lot of variables that can determine just like how well your round is going to do, like independent of what your actual what your offering in of itself is. The biggest thing I can encourage founders to do though is early rounds are all about momentum. It doesn't matter how good your company is; it's all about momentum, and investors have to have a feeling that when they're talking to you and they're considering investing, that they do not have time to just willy-nilly dilly-dally on doing the deal, right? I think the purgatory that some good companies I've seen sort of fall into is, they're very kind of they have this sort of we're not in a rush kind of thing to take your check mentality. And what ends up happening, let's say you're a pre-seed company, right? You don't have a lot of data around you anyway. Every month, every 2-3 months that you operate is valuable data to an investor. That the investor all of a sudden gets the comfort that they can sit there and say, okay, I mean, I like this, I like the team, but if I have no opportunity cost right now, it's sitting for 1-2 months and just watching them, right? Because it's the round's going to be open, it doesn't look like they're on track to fill it, whatever, or again, there's no urgency. I can sit there and I can get all these data points for free, basically. You want to make sure you don't fall into that, right? So I think there are certain strategies to take with kind of both organically and artificially introducing some momentum into your round that will make investors kind of act faster, and then that all kind of snowballs. But I think that's very, very important. It's the main thing. Pre-seed rounds are all about momentum. You want to have momentum, and that's all you should be thinking about.
Got it. Interesting. And I just wanted to understand, since you've been an operator, do you think angel investing helps, how you operate and, look at at an operational role, or do you think it's a bit of a distraction to be a founder and an operator and do angel investing?
It's an interesting question. I actually think about this a lot. And to be honest, I think it's very case by case, because also like angel investing, the nice thing I guess about angel investing is that you can largely decide how involved you want to be. Right. Like me personally, like I've always been a very hands-on angel, right? Because again, I just like doing that. Also case by case with companies, like some companies don't want my help as much, right? So obviously I don't deal as much with them, so on. But there's some people that are very happy to just kind of like put their money in and then like disappear. So I think it depends. But there's always data points that you can get from obviously knowing what other companies are up to, right? Like largely, like, I think sort of stuff like this that we just talked about, like fundraising and stuff, right? Like, hey, if angel invested in another company, like, is your best means of getting data points on just like how the market is and all these sorts of things, like it can help, right? But principally, I would say just conceptually, I actually don't know how I feel about, let's say you're like a founder and then you're investing, right? Yeah. Just from a sheer kind of commitment point of view, right? Because I think, let's say me as someone that's investing in your company, I want to get a sense that like, obviously you're 100% behind what you're doing. And so like, I'm like, okay, if you have all this money to like angel invest into other companies, like, wait, why are you not putting that into your own company, for example? Like there are obviously very like kind of strategic arguments that you can make for that, saying like, diversification, personal finance, right? I get all of that, right? So I'm playing devil's advocate with that position, but I think it can be, I guess, bad signal depending on your case. Like if you're, let's say, already like a super exited founder, you've done it already, right? Like you're just deploying some of your capital out. It's like, I think, different than if you're doing it for the first time. So again, there are always variables, but it can help. It can be a distraction. It can be a negative signal. I think it depends.
Got it. And what advice would you give to founders in regards to investor updates? But there's been a lot of talk about if a startup gives regular updates, monthly updates, there's a much better chance that they will be able to raise funding. But
absolutely,
how often should the investor updates be, and what makes the best ones in your view?
I say like, I encourage like my own founders. I encourage founders that even, I'm not investing now, but who knows, maybe later. I always say, put me on your updates. Like, again, obviously I'm on my portfolio company updates, right? But like even founders where I'm like, I can't invest now, or I'm not investing now, but I'm interested, you just put me on it. I have made investments on companies that I've passed on. I follow their updates for 3 months and then invested, right? So I always tell founders, like, I think this actually happens quite frequently, that investor updates can be one of the best, like, kind of passive promotion tools of your own company. Particularly, again, if you're kind of willing to share that with just generally investors that maybe expressed some interest but not actually invested yet. I always say do it once a month, particularly if you're early, like if you're a pre-seed company, do it once a month, because a lot can happen, right? There's a lot less kind of stability, obviously, with the pre-seed company. So I think if you set up updates once a month, it's great. And like, again, it's not causation, but I definitely see correlation between my companies do monthly updates and the ones that do really well, basically, right? Like I have some companies that do well that don't do them, and vice versa, right? But for the most part, the ones that are kind of more consistent in their communication tend to do quite well. I am always be very honest on it, right? Like, I think it's always good to say, like, here's the good, here's the bad, but most importantly, also like asks of LPs, or not LPs, sorry, of investors. Because I think sometimes founders might actually underestimate that, like, like how much network they already have invested in them by second degree. And two, that actually a lot of investors want to help, right? But the thing is that, like, if you don't tell them what you need help with or what the situation is, they can't help you, basically, right? So I think updates are absolutely the best way to, like, passively kind of solicit more investment from, people that you might have been speaking to. Because again, it goes back. I know a lot of investors that think in this sort of iteration pattern, right? They like companies that iterate very quickly. And so, hey, if you put someone an update and can show someone that over 3 months we're absolutely crushing it in terms of how fast we're iterating, you're gonna get a lot of people. You're gonna get a lot of people interested. And the second thing is just it's the best way to leverage your own investor network on all of this in a very passive way, which I think is a nice way to go about it, both for investors, who might be busy with a ton of stuff, and founders that you don't have to like do a bunch of individual reach out to people, right? But you can kind of solicit it. So I'm a huge fan of updates, and like any founder I talk to that doesn't do them, I'm like, please start doing them. It's probably the best thing you can do.
Got it. And obviously, I want to touch base about Silicon Valley Bank. It was really sad what happened, but I mean, there's been a lot of advice about which startups were not really thinking about that. You need to have 3 or 4 bank accounts. But would you still give an advice for startups to work with other startup banks like Mercury, or would you advise them to work with only the big banks?
Yeah, I mean, it's a good question. Again, I don't think anybody thought about this before SVB, right? So I think there's still a lot of like ideation on what the right strategy is. My personal opinion on this from the beginning actually has been, even before SVB crashed, but I remember when I lived in Silicon Valley, there are a lot of people ask me like, if I want to make like an SVB account and whatever, and all these sorts of things, or if I have one, I'm like, no. I'm like, I don't see why, right? Like, because first of all, I don't need it, but second of all, like of all the other uncertainty in my life, the one thing I want to be certain about is my bank, right? Like, I bank with Wells Fargo, no problem, whatever. I think the same thing still applies, particularly for startup. Like, your entire proposition is risky as a startup, right? You might as well just like de-risk operational aspects of it as much as possible. So like, again, this was never a topic, but if someone would have asked me even 6 months ago, I would have said, yeah, of course you should probably go with the big bank. Just it makes the most sense. But yeah, I think for the startup banks, this is definitely not great, right? I mean, like, I think even what you read about what happening to First Republic and all that stuff, a lot of people wanting to pull out, and it kind of, there was this huge risk of contagion, obviously, which would have been a disaster. I think it definitely isn't great for startup banks in of itself. But I think there are some services that, I've seen more of this now. I think even AngelList said something like this, so don't quote me on this, but that they're basically almost these services that are like actually manage your capital across different banks, and the actual service that you interface with is this one that's kind of managing your account across different banks. I think that could get interesting. There's always opportunity, these sorts of things, right? And I look at it. So like, is being a bank the opportunity? I don't know, right? But is being some sort of bank that does that financial servicing a potential opportunity? Absolutely, right? And so, yeah, again, it's always, I think when there's crisis, there's opportunity, but it might be different than how you thought, right? And so, right. Certainly, I think there's somebody's going to come with something very clever here. I do think on a kind of regulation level, though, there is something to say about this whole idea of like backstopping, right? Because obviously, like, reason that the government had to backstop SVB is that bank fails, right? Like all of your regional banks are probably going to go under over time. And I mean, just obviously the impact that has on the banking system, both in terms of like competition and monopoly and all these sorts of things, is probably the opposite of what the government would want, right? So there is something to say about maybe should this actually be solved at regulation layer, where there isn't a guarantee just on 250,000, but you raise that threshold by very serious margin. That could be another option. I mean, I've spoken to people about this that are smarter than I am in this space, but again, obviously, I think it sheds to light that there's going to be some opportunity for change, and again, some innovative mind somewhere is going to change it again. I would probably bet on the startup doing it, but more so than the government. But yeah, that's a positive impact for sure.
Got it. And I quickly want to do the top 3. What's your favorite business book?
Yeah, 0 to 1. I might take a lot of flack for that by Peter Thiel. Reason I say that is it's the only, I've read a lot of books where I read it and I was like, oh, that's interesting, or oh, there's something like useful in here, or whatever. I think that's the only book that I've read where it really like had this impact of like really profoundly like making me think about how I think about stuff, like at a very kind of like first principles level. I think kind of the way he like sums up the way the world works with like this kind of like quadrant of like indefinitely pessimistic, definitely pessimistic, like whatever that sort of thing is that he did. Really, really clever, and it was actually an inspiration. A lot of why we went after Rapify, which I mentioned earlier, was actually very much born out of a lot of the philosophy that was kind of talked about in 0 to 1. So I always say it's my favorite just sheerly from the impact that it had on my own kind of operation. And I still probably read it every now and then. I think it's a great book. I think, again, just from a first principles perspective, I think it's fantastic.
Yeah, no, absolutely. We'll put that in the show notes. And if you could go back in time when you started investing, what is the one thing you would have focused on or done things differently?
Yeah, I would have probably started by trying to find an emerging manager that I really like, both as the manager, but also like the industry that I want to be involved with. And start there, because I think the biggest thing with angel investing is like it can often be a cold start problem, right? Like a lot of people ask me this always. They're like, wait, I want to angel invest, like how? Basically, like how do I start? So I did this in a very kind of serendipitous way that actually took a lot of work. It's because I always kind of, I think, had this back thinking that like I do want to do this like very seriously, so I'm happy to put in the work, but like maybe some people don't, or even if you do, I think just getting involved with a fund is the best way, because you start getting deal flow. Like, a lot of like early funds, they'll give you co-invest opportunities. You'll get to actually see like working with the fund, you get to see a ton of companies, right? How they diligence it, etc. I think that can just be a really good way to kind of cold start, but also like give you a bit of a framework about like how to really look at it, like these kind of investment opportunities. Also just knowing other LPs and funds, a lot of them tend to have their own deal flow, right? Like there's just a lot of network, because investing is effectively a network play. Yeah. Right. So I think that's one of the best ways to kind of like really solve for the cold start in the network. If you don't already have it, is, be a small LP in an early fund, right? That you like, and just kind of roll with it, and like kind of, be an active LP. I think go a long way. So that's, I think if I was starting out again, like for sure, something I would have, knowing what I know today, really, really given a lot of consideration.
Got it. Interesting. And do you have any favorite online tools, for example, Gmail, Slack, so?
Has to be Twitter. Just what I mentioned, like investing is a network game. Twitter has by far probably been the best tool for me to like really build a lot of like meaningful connections on, especially during the pandemic time. Really like kind of a lot like the root, of a lot of relationships that I have, but then kind of blossomed into much bigger networks and stuff. They all kind of came from Twitter. Even beyond that, I think there's just, the spaces that I look at, it's the best way to keep up with what's going on. I think anything else I can find an alternative for, but like Twitter going away for me is probably the one thing where I wouldn't have an immediate answer about like how I'm going to solve for that gap. So yeah, I think I have to go with Twitter, despite all the, I think the nonsense that Elon's doing to it, but has to be one of those.
Got it. We'll put down in the show notes. And Arian, what is the best way people can reach out to you and know more about Earthling VC?
Yeah, I mean, I say I'm pretty active on Twitter, as I just mentioned. So I think follow me on Twitter. I'm linked to my homepage there and stuff, so if you want to email me, it's all there. So I can also like ping you offline my email and stuff. I'm happy to always take cold inbounds and all that, my Twitter, but like, yeah, Twitter, email, all that sort of thing.
Got it. We'll put down in the show notes. And thank you so much for taking our time speaking to us. Awesome. I really enjoyed my conversation.
No, awesome. It was fun. Enjoyed the chat. Appreciate it.